Get ready for a potential market shakeup, as traders are placing a high-stakes wager that the Federal Reserve will start raising interest rates as soon as July. This move, once considered unthinkable, is now being bet on by traders in the Fed funds market, who are wrapping up their shorts in anticipation of a rate hike. But why does this matter? It's because this bold prediction is being made despite a series of economic data that could potentially derail it. The traders' reasoning is that the Fed will need to take action to combat inflation, which has been stubbornly high, and a rate hike would be a drastic measure to tame it. This risky wager is a clear indication that traders are getting anxious about the Fed's next move, and it's not just the traders who are concerned. The Fed itself has been hinting at the possibility of a rate hike, and with the economy still showing signs of strength, it's likely that the central bank will take action to prevent it from overheating. As the market waits with bated breath for the Fed's decision, one thing is certain: a rate hike in July would be a game-changer for the markets. Moving on, let's take a look at what one of the Fed's own is saying about the state of the economy. Cleveland Fed President Beth Hammack recently spoke out about the current state of inflation, stating that it's been too high for the past 5 years. She also suggested that AI could be a contributing factor to inflation, and that rate hikes may be necessary to combat it. This is a significant statement, as it highlights the complexities of the current economic landscape. Hammack's comments also underscore the challenges that the Fed faces in trying to balance the need to control inflation with the risk of stifling economic growth. Speaking of challenges, European banks are about to face a whole new level of stress. APS Holding, a major investor in bad loans, is preparing to snap up distressed debt portfolios worth €3.3 billion. Why is this significant? It's because higher interest rates and real estate stress are starting to take a toll on bank balance sheets, and investors like APS are seeing an opportunity to capitalize on the distress. This could lead to a wave of consolidation in the banking sector, as weaker banks are forced to sell off their troubled assets. As we head into the holiday weekend, you might be wondering what this means for the stock market. With Independence Day falling on a Saturday this year, the market will be open for business as usual on Friday, but you can expect lighter trading volumes as many investors take the day off to kick off their long weekend. And if you're planning on mailing any important documents, be aware that mail delivery will be affected by the holiday. But even as the market takes a breather, the crypto world is still buzzing with activity. Bitcoin ETFs were supposed to be the answer to the cryptocurrency's notorious volatility, but that theory is being put to the test. With institutional adoption on the rise and a crypto-friendly administration in place, many had hoped that Bitcoin would be able to avoid the painful cycles it once experienced. However, the recent sell-off has raised questions about whether these ETFs are truly effective in reducing the cryptocurrency's risk. As the crypto market continues to evolve, one thing is clear: the next big test for Bitcoin is just around the corner. And speaking of tests, will the Fed's next move be the catalyst that sets off a market firestorm? Tune in tomorrow to find out.